For this video, I wanted to talk about a tax issue I've addressed a couple times before, and it's related to the Form 1099-K reporting issue when you get this, and it's simply because you were selling some personal items online, right? So you have used clothes, furniture, electronics, whatever it might be. You list it on eBay or Amazon, try to get rid of it, and after you sell the stuff, you get a 1099-K from eBay. What do? So in this video, I really want to hone in on what is the tax obligation and how does this kind of change a bit for the 1099-K. So got a couple examples in front of us that I hope will kind of clear this point up. When you're a U.S. taxpayer, you're required to report your gross income from whatever source derived, whether it's U.S. or foreign. If it's income, you've got to report it, unless there's a specific exemption that kind of pulls it out of that bucket. Right, and so one such income inclusion is if you sell property, so if you sell a capital asset for a gain. Okay, so the capital assets include investment property or personal use assets, right? Personal use assets are a capital asset. If you sell it for a gain, that's income to you. And I think that's something that shocks a lot of people. They didn't think they maybe had to pay gains on the sale of personal assets. You do. So if we look at the Form Schedule D instructions for 2021, they have this language in here, which I think makes it pretty clear. Right? It says generally the gain from the sale or exchange of capital assets held for personal use is a capital gain. Right? So it's reportable. You've got to report this on your 8949. And then it does specify, you do get long-term or short-term treatment depending on how long you held that personal asset for. Now, it further says that losses from the sale or exchange of capital assets held for personal use is not deductible. Okay? But if you have a loss from the sale or exchange of real estate held for personal use, so this is your principal residence, let's say, and you get a 1099-S, you've got to report that on the 8949, even though the loss is not deductible. And it's this key point here, which is why the reporting mechanism that I've covered in my other videos, and I'll put a link to that below, which is why if you get a 1099-K for a personal use item, you should probably be reporting it on your 8949, showing the loss, but then showing it as not deductible. Okay, now just to also reiterate there, personal use items, if you sell them, no loss deduction, but if you hold property for investment purposes and then sell it, you can take capital losses. So if you're holding stocks, bonds, if you hold real estate that's just for investment purposes, so you don't live in it, it's not your vacation home, it's just an investment asset, if you sell that for a loss, that's a capital loss, you can deduct that, but personal use items not deductible. So let's look at a gain loss examples and then how the 1099-K comes into play here. So for the gain example, we have John buys a new couch for $1,500 and he uses it in his personal home. Then John sells the couch 3 years later on Craigslist, right? So he just listed on Craigslist, somebody comes and get it, and he manages somehow used couch to get $1,600 for it, right? The guy pays him in cash. Now, John has a $100 gain here, right? And it's a gain on a personal use asset. Believe it or not, technically, this is taxable. So John has the gain. He has to report the sale of the couch, what his sales proceeds are, so the $1,600, the $1,500 cost basis, and the $100 in long-term gain because he's had it for 3 years. Now, I know what you're thinking. Like, this is ridiculous. Who in the world? Well, firstly, are you ever going to make money on the sale of personal use asset? Probably not. Most of the time, it's a loss. And then secondly, nobody's going to want to report this, right? And I get that, but I mean, it's my job to tell you what the tax law is, and then whatever you do on your side, you act accordingly. So now let's look at a loss example. Okay, so John buys a new pool table for $2,500, uses it in personal home, and then he sells it 2 years later for $1,500, right? This one makes a little more sense. He gets the $1,500 personal check, so his loss is $1,000. Now, this loss, and none of these examples, these first two, there's 1099-K reporting, right? Because he paid him in cash, check, there's no credit card transaction, there's no PayPal, there's none of that. Now, the loss of $1,000 is not reported on the 8949, right? So the IRS, again, they're only saying up here in that second bullet point at the top, losses from the sale of personal assets, one, they're not deductible. And then two, their point is you only have to really report it if you got a 1099-S from the sale of real estate and there was a loss, right? So in this case, John, he sold a personal use item at a loss, no 1099 whatsoever, so just don't report it. Leave it off your return, okay? That makes sense, right? Now here's where it's starting to get more complicated. And the 1099K reporting is going to require people to basically add more information to the return, even though it doesn't affect their tax liability. So we've got John here, he buys a new TV for $1,100 and he uses it in his home. He sells it 6 months later because he decides he wants a new TV. So he sells it on eBay for $700, ships it to the buyer, and then at year end, John gets a 1099K from eBay for $700, right? Because he has exceeded that $600 threshold. So now what does he do, right? He bought it for $1,100, he sold it for $700, he's got a $400 loss. Now, if there were no 1099Ks, we just wouldn't do anything, right? This is just like the example up here with the pool table. Don't report it, no big deal, who cares? But now that he gets a 1099K, it kind of forces the issue where he has to report something. Otherwise, the IRS might send him a letter and say, hey, we got a 1099K from this. You know, what was going on? Why didn't you report this? And I think the reporting mechanism now is analogous to this 1099-S issue for the real estate. The idea is if you get a 1099, the IRS has a copy of that, and so they're going to be cross-checking the information in their database with what they can find on your return. If they can't match up these amounts, then they send you a letter. And so that's why they require this 1099-S reporting on your return, because they've got a 1099-S. They don't know whether you had a gain or a loss. They don't know what your cost basis is, because none of that is reported on the 1099-S. So if you get a 1099K for the sale of personal use items and it's at a loss, my recommendation is to report it. Report it in this manner, similar to how you would report the sale of your principal residence at a loss when you get a 1099-S. Report the proceeds of $700, report your cost basis of $1,100, and then add an adjustment to show a non-deductible loss of $400. And at least if you report it in this manner, and the IRS kind of looks at your return, they could see that you did report it and that it's not trade or business income. It is personal use sale of assets that were at a loss. So hopefully they'll leave you alone. So I think that this is the way going forward. I mean, this might be their intent all along, is just to try to force people to do a little more reporting and confirm that they are in fact losing money on these sales rather than making money. Now, also to be clear, if you get a 1099K and you made money, yeah, you got to report that. So if we go back to the example up here where John sold his couch and made a $100 profit, if, let's say, for example, somehow, this is how it would work, right? So if he sold it on Craigslist and then he got $1,600 and then the buyer transferred him money via PayPal, that's $1,600, John would likely get a 1099K for that $1,600 amount. So now he's got to report the $1,600 in proceeds, the $1,500 cost basis for his couch, and then he's got a taxable gain of $100 on the sale of that capital asset that's personal use property. Okay, so I hope that kind of clears up the tax issues here. The gain or loss issue has been around forever for the sale of personal use property, but now the loss reporting is being picked up in a similar fashion to these the sale of your principal residences, because you're now getting a 1099. So so that's the takeaway. Remember, just if you sell property at a gain, it's taxable. I mean, this is the unfortunate reality of the U.S. tax system. And if you take a loss on personal use property, you get no benefit. So it's not great, doesn't sound fair, but these are the rules we're working with. And so, I hope this was helpful. If you have any other questions, leave me a comment below. Please do check out that other video I have on how to actually report the loss sales for personal use property on your 8949. I think that could be helpful for you. Okay, so that covers it. Thanks so much for watching, and I look forward to seeing you again on the next video. Thank you.